Hey everyone, welcome back to the channel. Today we're breaking down one of the most important economic stories of the week, the Federal Reserve's December 2025 meeting minutes, and what they tell us about future interest rate cuts and the US economy. If you want clear, no-nonsense explanations of financial news like this, hit that subscribe button and ring the bell so you never miss an update. First, what exactly are Fed minutes? After every policy meeting, the Federal Reserve releases a detailed summary of discussions from its Federal Open Market Committee, FOMC. These minutes give us clues about how policymakers are thinking, especially about interest rates and economic risks. They're like a behind-the-scenes look at central banking. At the Fed's December meeting, officials cut interest rates by 0.25%, bringing the federal funds rate down to a range of about 3.50% to 3.75%. This marks the third consecutive rate reduction in 2025 as the Fed responds to a cooling labor market and broader economic concerns. But it wasn't a simple decision. The minutes show significant disagreement among policymakers. Some preferred keeping rates steady, while others even wanted deeper cuts. The big headline from the minutes is this: most officials still think additional rate cuts could be appropriate if inflation continues to fall over time. But here's the twist. Not everyone agrees on when or how far those cuts should go. Some members want to wait and see more economic data before acting further. That tells us there's no Fed consensus, just a general leaning toward future easing if needed. Now, why this division? There are a couple of key reasons. Inflation is cooling. Recent data shows inflation coming down, which supports rate reductions. But the labor market is weakening, with unemployment edging up. Some policymakers want to help support jobs with more cuts. Others worry that cutting too fast could hurt inflation credibility. This push-pull is central to the debate. So what's next? The minutes suggest that while most officials favor additional cuts eventually, many are cautious about acting immediately. That means the Fed could pause early in 2026 before making its next move. Markets are watching closely for jobs data, inflation readings, and the Fed's next policy statement, all of which could influence the timing of future cuts. Now let's get practical. How does this affect everyday people? Borrowers. If the Fed cuts rates again, loan rates, mortgages, and credit cards could get cheaper over time. Investors. Lower rates might boost stocks, but uncertainty can mean volatility. Savers. Unfortunately, interest on savings accounts could stay low. So even though this sounds like dry economic policy, it actually affects the cost of borrowing, saving, and investing in real life. Markets have already started reacting. Treasuries and stocks are moving based on expectations for future rate moves. Lower future rates generally make bonds more attractive, and stocks rally on the prospect of cheaper money, but only if growth sticks around. As traders parse the Fed's language, every word in the minutes matters. To recap, the Fed cut rates in December 2025. Most officials support the idea of future cuts if inflation keeps easing. But internal disagreement means timing and size are still uncertain. We're watching closely for the next meeting and key economic reports in early 2026. If you found this breakdown useful, smash that like button, subscribe, and hit the bell icon for more updates on the Fed, markets, and how economic decisions impact your money. Comment below. Do you think the Fed will cut again in 2026? Let's talk about it.